You think the Supreme Court just handed corporations a massive tax break, but Washington is about to slap a 15% global tariff right back on the table. While the Middle East prepares for the largest military conflict since 2003, the U.S. Chamber of Commerce is demanding a $133 billion refund, but the administration is already drafting new trade penalties. Meanwhile, Israel's Security Cabinet is meeting tonight to discuss an imminent strike on Iran. Add in 20,000 escaped terrorists in Syria, and your risk premium is entirely mispriced. Stick around because your energy and consumer stocks are in the crosshairs. The Supreme Court struck down the emergency tariffs, and now American businesses are demanding a swift return of an estimated $133 billion. The market expects a massive margin expansion for retailers, but they are ignoring the immediate retaliation. The administration is already pushing a new 15% global tariff to replace the loss. This means the supply chain chaos isn't over. It is just resetting. If you hold consumer discretionary stocks, their cost of goods sold is about to become completely unpredictable. This isn't a permanent tax cut. It's a temporary illusion before the next margin squeeze. Israeli Prime Minister Benjamin Netanyahu is convening his security cabinet this evening to discuss a broader regional confrontation and a potential U.S. attack on Iran. The United States has begun repositioning hundreds of troops across the Middle East, moving forces from Qatar and adjusting naval assets. Analysts are calling this the biggest military buildup in the region since 2003. The crowd is treating this as standard political posturing, but the logistics say otherwise. If a strike happens, the Strait of Hormuz is in play, and your portfolio's energy input costs will explode. This raw material shock will bypass revenue and directly destroy operating margins across every logistics sector. While everyone is watching the aircraft carriers, U.S. intelligence just confirmed that up to 20,000 people, including Islamic State affiliates, are now at large in Syria. Security at the massive Al-Hol camp completely collapsed. The market is pricing geopolitical risk at zero, assuming the Middle East is contained. But a mass release of radicalized militants means asymmetric warfare and terror risks just spiked across the entire region. This forces a permanent increase in security and insurance costs for any multinational corporation operating near the Mediterranean or the Gulf. The geopolitical discount you are paying for global equities is fundamentally wrong. Former Dallas Fed President Richard Fisher just went on television to declare there is absolutely no present need for the Federal Reserve to cut interest rates. The market is still desperately clinging to the hope of multiple rate cuts this year. But with inflation risks reigniting from new global tariffs and Middle East oil shocks, the data simply doesn't support a pivot. If you are buying unprofitable tech stocks on the assumption that borrowing costs are going back to zero, you are doing the math wrong. Higher for longer isn't a talking point anymore. It is the structural reality eating away at your future cash flows. Despite these massive macro threats, the corporate deal machine is completely ignoring reality. Auto parts maker Cooper Standard just priced a $1.1 billion senior secured note. Wall Street is cheering the robust appetite for high-yield corporate debt. But retail investors are being lured into a trap. While traditional bond markets look open, companies are piling on expensive debt at the exact moment global supply chains and energy routes are facing existential threats. If you own highly leveraged industrials, their free cash flow will be vaporized by interest expenses the second revenues take a hit. Tomorrow, keep your eyes on the 10-year Treasury yield and any sudden spikes in Brent crude as the Israeli cabinet concludes its meetings. This isn't financial advice. Keep your eyes on the margins. I'm Wilson, and I'll see you tomorrow.